people think this is rigged somehow against them. And I'm certainly not smart enough to know if it's rigged against us or not. But I mean, I'm just trying to get to the heart of the matter.
I mean, look, personally, I'm in this business. I make a living in this business. So maybe you say I'm conflicted, but I believe in actually, investing and finding value and finding good investment opportunities. And I believe you can do that. So do I think it's rigged? No, I don't think it's rigged. Can I understand how the little guy may think it's rigged? Yeah, I think the little guy thinks a lot of the world is rigged because frankly, it is kind of rigged against them. Right. And that's, in anything in life, you need to have scale to be quote unquote successful. And, whether you're got a bunch of software engineers or whether you have a hotel, you can't make money in a hotel with 3 bedrooms, right? You need scale. It's the same thing with everything else. You need scale.
My name is John, and this is Please Allow Me. I put this episode together quickly because the topic is kind of time sensitive. Who the hell knows when the meme stock bubble is going to burst and my dreams of being hand-fed grapes in the warm Mediterranean sun will be shattered. My buddy Paul owns a hedge fund and he knows a shit ton about the stock market, so I wanted him to primarily educate me on some of what's going on between the institutional investors on Wall Street and the retail investors, many of whom are on Reddit and other social media platforms. The internet is full of some really good information, but it's also full of some bullshit, regardless of whatever industry you're in. I don't know enough about this topic to be able to tell the bullshit from the good intel, so I thought I'd have Paul come on in and clear some of this stuff up for me. To be clear, I own some of these so-called meme stocks, and Paul runs a hedge fund, so as we're approaching this from opposing viewpoints, I tried to be fair to my friend, but I also wanted to get to the heart of the matter. I missed an opportunity to ask a few additional questions here, mostly because it was Tuesday night. Paul's wife was texting him off the hook to get his ass home. My big miss was failing to ask Paul what he thought about government officials who make policy playing the stock market. While I think it's wrong to infringe upon anyone's personal financial freedom, sometimes you have to make trade-offs in life. Should a person in charge of making policy also be able to benefit financially when that policy creates a booming industry? That seems like the ultimate in market manipulation to me. Should Nancy Pelosi be able to own millions in Tesla stock while pushing her green agenda? That doesn't seem right to me, but what the fuck do I know? And she's certainly not the only politician on either side of the aisle taking part in this type of market manipulation. But whatever, that's maybe another podcast. Anyway, without further ado, please allow me to introduce Paul Karger. On a rare Tuesday night appearance here in Podcast Alley, I got my friend Paul Karger here to talk about Reddit versus Wall Street. Paul, before we get started, can you tell us who you are, what you do, and establish a little credibility for people who think I'm absolutely full of shit?
Absolutely. So I run a firm in Boston, between Boston and London, called TwinFocus Capital. We manage about $7.5 billion for a selection of very wealthy families around the world. I also hold a CFA, a Chartered Financial Analyst, and I've been in the investment business for over 2 decades.
So for people who are just wondering what the dynamic is here, Paul and I are friends. I hold some shares of GME and AMC. I don't want people to think that I invited Paul in here as a layup to defend Wall Street. And I'm not one of the wealthy families that Paul represents in the stock market because all my money is under my mattress. So let's get started. One of the things I want to do is I want to clear up some of the key terms here. One of the things I notice is that the internet makes experts overnight. I see this as my business is in MMA. Every time there's a big fight, Monday morning, the shit that's online and the insider terms I hear people dropping and using incorrectly so that they sound like insiders is it's dumbfounding. The number of people I've heard talk about, I'm not in this to screw Wall Street, I like the stock or this or that. Motherfucker, you don't even have a stock portfolio. We both know that. So let's start by defining some key terms if you'll help us do that. Is that cool?
Sure.
Okay. What is a hedge fund and how does it differ from a traditional brokerage house?
Sure. Hedge funds were really started in a very limited way back in the 60s, but really kind of came to prominence in and around the 90s. A hedge fund is a very loosely defined term that really means a commingled pool of capital, which has very little restriction in terms of what it can do. Hedge funds in today's regulated world are offered by with a private placement memorandum, where managers basically have to define exactly in and around the space that they're going to be investing in. And it also will provide a bunch of disclaimers around things that they can get away with as long as they tell you that they might do them up front.
Okay.
But in addition, I should mention, hedge funds are able to garner, generally, if they have good performance, garner much greater fees than traditional investment management. For example, if you were to invest in a mutual fund or an exchange traded fund, you're probably paying less than 1%. However, in the hedge fund world, they charge very high management fees. There's the expression of they charge 2 and 20. They charge a 2% management fee, and they charge 20% of the profits. So you can make a lot of money running a hedge fund if you're successful.
Is it somehow riskier? Is that why the profits are greater?
Absolutely, it's riskier because you're investing. You've got two forms of risk, really. You've got investment risk, where you're investing in perhaps an ill-defined strategy or a strategy which gives the manager a lot of flexibility. But you've also got operational risk, whereby effectively you're not just investing in an investment product, you're investing in a small business, and things go wrong with small businesses all the time. Partners have disagreements, whatever it may be.
Tell me about it. So what exactly is a short? Everyone's going, oh, short this and short that. I don't think anyone has any idea what they're talking about.
Shorting is a term to refers to the ability of an investor to, in some ways, it's considered hedging a position. Effectively, what you're able to do with a short is, without owning the share of a company, you can borrow that from somebody. Call it a bank. Similar to a bank, they're going to charge you a certain percentage to loan you that share. If it's a very widely followed stock and a very liquid stock like a General Electric or something, maybe it's a few percent to borrow the stock.
Is it a percent of the current stock price? That's what they're charging you?
It's a percentage of the balance. So you're effectively making a loan. So if you're going to borrow, call it 100,000 shares, you're going to borrow it for 5%, you're going to pay $5,000 a year. Some stocks, they charge, the broker dealer will charge a lot more to borrow the stock. So you have to think about, if I'm going to short this stock, what's it going to cost me? Do I think I'm going to make more than it cost me? It could be as much as 20%. So you borrow the share of stock, you turn around and you sell the share of stock. And the whole hope is that you can buy the stock at a lower price. You believe the stock's going to go down. So you borrow at 100, you pay 5% a year, you hope to buy it back at 80. If you, in this example, if you hold it for a year, you make a $15 profit, right? The challenge though with shorting is it's very different than going long, because going long, just buying a stock outright, you effectively have the ability to lose 100%. So if you invest 100, you can lose 100. The problem with shorting is, if a short goes against you and the stock moves in the other way, you can lose multiples of hundreds of percent.
Gotcha.
Right?
So I used to borrow car stereos and bring them to the pawn shop and sell them and hope that in 3 months they'd still be there and I could go back and repurchase that car stereo for less money than I sold it to the pawn shop for. They called that fencing stolen goods. How is this different than what I was doing to get beer money in the 90s?
So that's effectively shorting, right? You were effectively short the radio.
I'm very prolific.
Very, very prolific. You always have been. But, you're effectively short the radio. And your challenge there is, if all of a sudden, for some reason, that radio becomes worth a lot of money.
Like it was a vintage radio and I had no idea.
Or somebody bought it and just decided, you know what? I don't care. I installed it in my car. I'm not going to give it back to you. And then you say, well, I'll give you 30. No, I'll give you 40. No, I'll give you 50. All of a sudden it costs you a lot more to buy it back.
So is there any similarity to like selling these things and having people hold them to when like the Franklin Mint says they're going to issue a commemorative silver dollar coin, and then they sell you they sell you basically a silver dollar for more than the price of that silver dollar, knowing that you're not going to spend it. It's going to sit in your closet and you're going to hold it.
I mean, that's kind of every game, right? That's retail, right? I mean,
right.
With a markup.
So what's the difference between the price of a stock and the market value of a company? Because as I understand, in like this whole meme stock thing that's going on right now, the total price of the stocks out on GameStop is greater than the value of the company. Is that correct?
Correct. So you have to define market value versus intrinsic value. So the market value of the company is basically all of the number of stock that are available, the shares of a stock available times the market price, and you come up with a market value. What you're trying to determine as an investor, whatever you're investing in, whether it's real estate, radios, or stocks, is you're trying to either buy something less than it's worth and sell it for what it's worth, or you're trying to sell something for more than it's worth and buy it back for either what it's worth or less than what it's worth. So, so what an investment manager does when you're going quote unquote long, or you're looking to invest in a stock, you believe that, you're going to buy it at 100, but you believe the intrinsic value of that company is actually worth 150. You think the market has got it wrong. And you think that you know more than the market for whatever reason, because you've built a better model or you've counted their inventory or whatever, and they've got it wrong, and you believe you're going to make money on it.
So then what is a short squeeze?
So a short squeeze happens when you have a manager or multiple investors look to short a stock, and they go short the stock. And what happens is, if all of a sudden there's a rush to buy that stock back, very much like you going back to that guy with the radio and saying, I need that radio back. I need that radio back. You're effectively creating a short squeeze on yourself because you're driving the price up.
Mm-hmm.
But that's what happens in the market, is there's a short squeeze when all of a sudden everybody realizes that they need to cover, quote unquote, cover their short and buy their stock back. It's the stock market is all supply and demand. Right?
So I was going to say, what causes people to go and want to buy those stocks back in short squeeze?
Could be anything. Could be some kind of fundamental reason. Could be the fact that you just believe the intrinsic value has matched the market value, right? And for whatever reason, there's a rush to get out. Maybe some negative news, right? Maybe a biotech company comes out with negative results on its cancer drug and people want to sell the stock.
Does the interest from the lender affect the point at which people want to buy back their shorts?
It's all a self-fulfilling prophecy.
Okay.
Right. People see stock, the price of something moving. People are wondering why it's moving. They feel like, geez, it's going to move against me. And very quickly, as I mentioned earlier, where you can lose multiples of what you invest in, not just 100% downside, very quickly, you panic. You need to cover, and the problem is to short. You're often borrowing capital. Right. And these banks that lend you capital are called broker dealers. They have their own margin requirements. And so they need to make sure that there's proper collateral to cover.
And what is the float?
Float, the easiest way to understand float is, if you think about, if I own a company and I decide to take the company, quote unquote, public, I may not, in most times, I'm not going to go and take 100% of the stock of the company public. I may only take 20% of the stock public. Well, there's actually another 80% of shares behind that. The float is that 20% that's out there trading in the market.
Okay. So when people say things like there's 130% of the float still out there, like, what does that mean for people like me? Like, how do I understand that?
The problem is there's borrowed shares out there, right? And those borrowed shares create this kind of mismatch. But that said, I mean, I truly believe that shorting is a market function that's kind of necessary to create efficiency.
So just getting back to the short and the squeeze, how did all the people on Reddit figure out that there was going to be a squeeze on this GameStop stock?
Well, what they did is they created the squeeze. So, I mean, if I can take a step back and kind of characterize the situation as I kind of see it. I mean, the first thing I should say is that I'm not giving investment advice in this discussion.
Noted.
But essentially what you've had happen over the last, call it, year since the pandemic has struck, you've had this confluence of factors that's gotten us to where we are today. You had the pandemic, which initially effectively canceled all sports betting, right? Because live sports was non-existent. You had a bunch of people sitting at home and figuring out what they're going to do with their time. And, smart people find interesting things to do. You, at the same time, you've had the onset of these platforms like Robinhood that have offered essentially what we call in the investment world frictionless trading, no cost trading, where you can buy and sell stuff for free. Historically, that's never been the case. In any kind of asset you trade, whether it's buying and selling a house or buying and selling a stock, you have to pay a fee. But what's happened is there's been this kind of democratization of trading and of the investing world. And, very much what a Facebook has done to kind of socializing and communication, these platforms have looked to, democratize trading. And, truth be told, when you look at the Schwabs and the Fidelities of the world, where they've effectively had to compete and offer zero cost trading as well. But essentially, you've had all these folks at home, they can trade for free. You don't have sports betting. All of a sudden, with platforms like Robinhood, you can set up small accounts. You can set up an account with $1,000 or $5,000, and you no longer need to buy full shares. You can buy fractional shares. So you can build a portfolio at, $1,000 or $2,000. And, and then on top of all of that, you've had all of this kind of social interaction of these online chat rooms. So when you look historically, retail of the entire trading, we talk about retail, we're talking about individuals like you and me, or maybe not me, but individuals that have little accounts that you're trading, your IRA or your taxable accounts considered retail. Retail is typically taken up around 14 to 15% of the trading volumes. Today, retail is taking up more like 20%. But the issue is that 20 is concentrated in a few names. And so what platforms like Robinhood have done is, in order to go out to the masses, invest your $1,000. The way Robinhood works is, I don't know how the entire model works, but I have question over the kind of long-term sustainability. What they do is they sell their float. They sell their flow of brokerage transactions. So, me and you can go on the platform, we can trade for free. Robinhood needs to make money somehow. They turn around to this giant trading firm based in Chicago called Citadel. And Citadel takes those trades, they go out in the market and they execute, and they keep what's called a spread. They keep the difference between the buy and the sell. And they turn around and pay Robinhood a fee for that float. So, Robinhood, while they claim that they're kind of taking from the rich and kind of giving to the poor, so to speak, my director of research that works at TwinFocus, my partner, Jeff, he always says, if you can't figure out how you're paying for it, and you can't figure it out, you are the product.
Right.
So
if you can't spot the sucker in the room, you're the sucker.
You're the sucker. Right?
So, like, going back for a second, like, given the everyday utility of the shorts and how potentially risky it is, I'm sorry, what's the everyday utility of the short, given how potentially risky it is?
So let me come back to, where we were in this, the whole genesis of this. So, all of this stuff is going on in the background. This company called GameStop. And, I think there's no secret that, GameStop is effectively a dying business. It's kind of today's Blockbuster.
Right.
As, everything's moving online. And this company is in kind of a long-term secular decline. And so you have a handful of managers out there that are, hedge funds, are typically looking to go long or buy the stocks that they really like, that they think are going to go up. And to, quote unquote, hedge their positions, they go short. And they short quote unquote single name stocks. Some managers today are moving away from this and have been, this is a common practice of, instead of shorting single names, you can actually short indices. So you can more kind of, hedge your market risk. But nonetheless, managers that are looking to add value and believe stocks are going to go down are going to short single name stocks. GameStop, right? You've got a declining business. You're going to go long the stocks you really like, and you're going to short these companies that you think with time will go to zero, so to speak, or go down a lot. It makes a lot of sense, right? It's actually a pretty, understandable trade. You go long stuff you like and go short stuff you don't like. And, Income Melvin Capital, this guy comes out of Gabe Plumpkin, I think his name is. He comes out of, fact check on that.
Get on it, Guido.
He comes out of SAC. He used to work for Steve Cohen as a trader, and he launched his firm, and he had a big launch, billions of dollars. Today manages like 12, pre this crisis here, managed about $12 billion. And these guys, these hedge funds, they also run with a lot of leverage, which we haven't talked about yet. Effectively, just like all of us, if we go buy a home, you put down 20% or 30% of the capital, the bank's going to willing to loan you money and you can buy a lot bigger home.
Right.
Well, hedge funds do the same thing. They borrow from the banks and they have, call it 20 or 30% or sometimes less than that of capital. The banks loan them money and effectively the hedge fund has to take the first loss, right? The bank doesn't take the loss. The bank wants their money back plus their interest rate. And so Gabe and his team came into this, situation, long their portfolio and short this and other stocks that they believe are going to go down.
So is this what market manipulation boils down to? Like these guys coming out and saying like how do who's the guy? Was it in my notes here, is it the restaurant guy who was like, look, all these restaurants are going to fail, so he shorted them all, and then he went out. He first went on and publicly said, look, all these restaurants are going to fail. Then he decided to short the stocks for those restaurants. I mean, is that market manipulation?
So there's different types of market manipulation. Certainly that can happen. There's something called front running, where maybe you get in front of trades that are going to occur. What you can't do. So the SEC this is illegal, right? You can't manipulate markets. The SEC gets involved in markets to help protect investors. Despite what folks may think, that's why they're there. They're a regulatory body.
But I guess that's where the
commissioner in Massachusetts on the State Athletic Commission.
Right.
We're there to protect the athletes and to protect the sport, and it's the same thing with the SEC.
People like me though will wonder, where's the tolerance line for market manipulation, for what they'll allow versus when they decide, you know what, that's quite enough. Now I'm going to go ahead and protect these people. I mean, I know someone who worked for the SEC and then turned around within a year and then worked privately for a hedge fund. I mean, things like that seem to be like a gigantic conflict of interest. You're basically going from one industry to the other to tell people how to get away with shit.
Well, it's not get away with stuff. It's actually, I have a head of compliance. I've had former heads of compliance that were from the SEC. And it's not get away with stuff. It's the same reason you may hire an attorney that used to be a judge, right? Because you know how the system works. And, personally, since, it's very different for me, since I own a business in this space, I actually consider my compliance department like my partner. I want to make sure I follow the rules.
Right.
And, it's a heavily regulated industry. And, I realize that, and by the way, I don't charge 2 and 20. I wish I could make 2 and 20, but, and I'm not necessarily on the side of the Wall Street fat cat, but, I think that generally Wall Street is a place where it's trying to separate investors from their money. And regardless of what you invest in, and regardless of who you hire to invest your money, you have to kind of understand that. And, when you hire somebody to invest your money, hopefully you can align your incentives.
Right.
But when these hedge funds, the problem with hedge funds is incentives and other, and other funds like this, incentives aren't necessarily aligned, where the manager makes 2% just to wake up in the morning.
So
right?
it doesn't seem too much different to me than taking, a couple grand and going up to the casino. The house has an edge. I go in there and I know the house has an edge. I'm going to gamble anyway. I may win, I may lose, but I don't get pissed at the casino. Sometimes I get pissed at the casino but it's my own fault when I can't afford pancakes in the morning. But why is there so much vitriol, do you think, right now between what, people are calling like the Redditors or the retail investors and the people who operate the hedge funds? Sometimes you win, sometimes you lose. There's definitely a feeling online, and that's all I can talk about anecdotally, the people I speak with, that they're getting back at the man, or that the hedge fund people, the Wall Street, the SEC, everyone's in bed together and they're out to screw the little guy, and they're manipulating the market when it benefits them. And then they turn around and do things like halt trading, limit the share sales to one at a time on Robinhood. How do things like that happen? And what is a logical explanation for those things?
So I understand how it feels like, everybody's against the little guy. I will tell you, if anything, it's the SEC is versus the investment community, right? The SEC is considered the police in the investment business. Cops
get bought off all the time.
I don't think that goes on. I just don't. I mean, I just don't. I mean, I think that there is manipulation in other ways, but I think the SEC is very on top of this stuff. Insider trading. There's been huge cases with guys that big billionaire guys that have gone down for insider trading. And all of that stuff I think is market manipulation. I mean, market manipulation in stocks is saying things that are not true, right? And then getting in front of that. I mean, in the end of the day, generally the professional investors are. Yeah, and I'm not speaking for algorithmic trading, but I think fundamental long, short hedge fund managers are looking to find value, right? Looking to figure out where they can, I mean, to be a successful investor long term, you've got to figure out how to mute the noise. Right. Because that's what drives markets day-to-day noise. Graham, the legendary investor, used to say that the markets short-term are a voting machine and long-term they're a scale. Because fundamentals come out in the end of the day, right? You just need to make sure that you have the ability to stay solvent, right? John Maynard Keynes would say that the markets have the ability to stay solvent, irrational longer than you can stay solvent. And that's effectively what's happened over the last couple of weeks here. The markets were super irrational and the managers couldn't stay solvent. So you had Melvin Capital that was trading in this. They had experienced like 50% down losses. They, a huge hedge fund invested in by other big managers. These managers had to come in and write $2.75 billion in checks to save these guys from having to sell their stock. What happened, back to your earlier question with the SEC, is the SEC came in and, when they halt trading, what they do is they halt trading because there's so much volatility in stocks. They don't want people to get hurt by this. And that's why they're there. It's
which people though, in this case, it seems like the people they didn't want to get hurt were the hedge fund managers, and the people that were not getting well in the meantime were the retail investors. So that's where the perception comes from.
So I think, over the last week, it's all come out what happened with Robinhood, right? And, effectively what happened with Robinhood is, I talked earlier about this 15 going to 20% of retail investors investing. A lot of that volume has been concentrated to the Robinhood platform. And as I said earlier, these platforms, these brokerage firms, they need to be capitalized with capital because the SEC and the regulatory bodies require a certain amount of balance there, of reserve capital. And they ran out of reserve capital.
Okay.
And they were literally, they saw it coming and they saw a train coming at them and they had to shut things down. Over the last week, as we've seen, Robinhood's raised like $3 or $4 billion. Fact check on that.
So that's like if I put on an MMA show, I've got to have all the fighter purses and everything in escrow to be sure that everyone gets paid on time.
Exactly.
Okay. So it's not necessarily that people online think that they stopped the trading so that I can't continue to make money. It's that there are safety markers in place and they were not able to comply with those safety markers.
Correct.
And the perception certainly can be that the safety markers in this case are in place to protect like the big guy and not so much the little guy.
Correct. The casinos do the same thing. The casinos are required to keep a reserve. If not, they have to stop trading.
Right.
The thing that I would say is, I mean, on one hand, I agree with you that in many ways, the stock market is like a casino. Again, successful long-term investors try to figure out how to mute the noise and figure out what works. Right. But ideally, the average hedge fund investor is trying to find value. They're not looking at it as betting. It's very different than sitting at a screen buying and selling. I mean, first of all, that kind of trading, this day trading, for at least the types of hedge funds I invest in, it's not tax efficient. So you got to buy and hold stocks that you believe.
Well, what makes something tax efficient?
Well, currently under the current tax regime in America, you pay, call it 40 or 50% when you sell anything less than a year, that you hold less than a year, a stock or real estate.
So they're encouraging you to hold it.
You're encouraged to hold generally things. If you hold things long-term in the U.S. currently, and this is under review and consideration by the Biden campaign, but currently you pay about 20% on long-term gains and 40% on short-term gains. Under Biden, they're considering making short and long-term gains the same amount, which would,
well, which way would they move the needle, to the high side or the
high
low
side? Everything would be priced at short term.
Gotcha. So all my buddies with the paper hands who went out and saw the dip and they sold all their GME and their AMC, they're going to have to pay 40 to 50% on that anyway. Okay. So you hear that, dipshits? All you guys who went and sold your stuff because you wanted $300 worth of profit, you're going to wind up with $150. It's not going to cover my bar tab before 9:00. Fucking people. Ruin it for everybody.
Short-term taxes are killer.
So when the SEC steps in and they halt trading, I understand now that there are safety markers involved, but wouldn't it be easier to not have those safety markers involved and let an actual freer market run its course?
The SEC does this not only with single name stocks, but they also do this with the entire market, right? There are a fact check on this, but I think when the market's down 1,000 points or up 1,000 points, it hits a circuit breaker where it takes a rest. And the reason and then they let it resume trading, and what they want to have happen is let news come out. 7%. They want the news to come out, and they want some rationality to come into the markets. And and so we actually saw this.
So they're manipulating the market.
Call it manipulating, but again, what they're trying to do is protect investors. The issue is there's a lot piled on these markets today, right? It's, in addition, which is what exacerbated this volatility over these last couple of weeks. It's not just stocks going up and down, but as many have heard, people have been trading options on these names, right? So there's
a whole other thing I don't even understand.
Whole other thing, right? Whole other thing. And, you've heard about suicides on the Robinhood platform because people woke up and they realized they were down 750,000 and they were negative and they had no ability to pay that back, right? That's what can happen, right? And, that can happen to institutional investors. And by the way, when we talk about institutional investors, we're ultimately talking about individuals because most of these folks manage pension funds, right? And things for...
Right, because an institutional investor is just made up of a lot of individual investors, right?
In part, there are other types of institutional investors today, like sovereign wealth funds or insurance companies or, other types of...
So I understand that the SEC steps in to kind of like take a breather and make sure things don't turn into total calamity here. And obviously they make the law, so that's legal. But is it moral? Is it moral to step in when you set up a system to kind of like run itself and then you just apply the brakes at an arbitrary moment where you think that things could get out of control here, so I'm going to stop everything right now? Is that moral to do to people? Shouldn't you, like both the winners and the losers? I know
you're a philosopher, but it's like, is it Adam Smith? Fact check on the invisible hand.
Guido's working hard tonight.
The invisible hand of right. Adam Smith, right? I mean, this is what government's here for, right? I mean, is it moral that we pay taxes, right? Or is it moral that I pay a lot more in taxes than you if you make, 100 grand versus what I make, right? Is that moral? I mean, this is what government's there for. Government's there to try to keep everything on the rails. So,
yeah, I agree with you that government's there to keep it on the rails. I just, it's, another conversation. I don't agree with the way that they do it and which rails they keep which people on. I think it's kind of
but that changes too, right? Yeah. Depending on who's in office and who's appointed for various positions. And, it changes. I mean, and there's all this other perverse conflicts and stuff. And, so.
There was an idea last week that I read online that someone from Robinhood was whistleblowing, and they had said that the White House called and said to them, and maybe this falls under the umbrella of what we just talked about with the trading halts and everything, that the White House called and said, you've got to stop the trading, limit the shares to one per sale. Does stuff like that ever happen? I mean, is there someone sitting in a White House office that says, Robinhood, stop doing this? And
so first, to be clear, from what I understand, when Robinhood prevented their investors from quote unquote trading, and this, you'll have to do a fact check on this, I believe they prevented them from buying, not from selling. Right. I think, I think the issue is I don't think you can prevent investors. I mean, I think it's some kind of SEC violation unless there was some like big exogenous macro event, where you just couldn't sell. But, I know, from being an SEC registered investment advisor, like if a client wants to sell something and you don't follow those directions, you've got blood on your hands. There's culpability there, right? And so I think they were allowing investors to sell, but they had to halt buying because they didn't have the capital reserves to be able to go out in the market and trade, and the volumes had increased so great.
And so where did they get the capital reserves from? Banks?
Well, initially investors, but initially they didn't have them. So they had to, and I think the CEO saw this coming and he had to just, he was getting advice from his probably legal and compliance folks, stop things. And then then they were able to raise additional equity capital, which they've done. And, clearly they have a lot of loyal investors because I think they've raised 3 or 4 billion, like we said.
Yeah. Like since Thursday or something.
Yeah.
How much, Guido? 3.4 billion. Yeah. Last week there was like $1 billion, and then, couple more this week. Okay, so all that being said, it seems like, a lot of these big Wall Street firms, they privatize the gains and they collectivize the losses, kind of like in 2008 housing crisis. So that means they don't really have any skin in the game, and therefore they don't really have any reason to mediate the risk. So that really pisses normal people off. Is this an accurate representation? Yes or no?
At the margin, I think it's accurate. But Wall Street firms make money by taking risks. So they do take risk, but they take very deliberate risk. So they look to quote unquote hedge out risks that they don't want to take. So, in the housing crisis, there was a lot of scrutiny over Goldman Sachs, who, on one hand was selling mortgages to the clients, but on their personal balance sheet, they were actually short subprime mortgages. That's the game, right? And it's the same thing that a corn cropper would do, right? Where you're long a bunch of corn, you can go sell it forward in the market, in the futures market. So in businesses, you look to hedge, and Wall Street is no different.
Gotcha. So would that fall into the category of when people say this game is just rigged? People think this is rigged somehow against them. And I'm certainly not smart enough to know if it's rigged against us or not. But I'm just trying to get to the heart of the matter.
Look, personally, I'm in this business. I make a living in this business. So maybe you say I'm conflicted, but I believe in actually, investing and finding value and finding good investment opportunities. And I believe you can do that. So do I think it's rigged? No, I don't think it's rigged. Can I understand how the little guy may think it's rigged? Yeah, I think the little guy thinks a lot of the world is rigged because, frankly, it is kind of rigged against them, right? And that's in anything in life, you need to have scale to be quote unquote successful. And whether you're got a bunch of software engineers or whether you have a hotel, you can't make money in a hotel with 3 bedrooms, right? You need scale. It's the same thing with everything else. You need scale.
Gotcha. Should brokerage firms like Robinhood be allowed to sell the data they gain from retail investors to larger firms like Melvin Capital? Is that ethical?
Wall Street is this place where you can kind of do whatever you want if you disclaim or you disclose. And so I think they get away with it, and I'm not an expert on the regulatory side, but I think they get away with it because they, in the fine print, they disclose, just like Facebook, sells your information, your data to give you that platform. It's in the fine print. So, is it ethical? I think like anything in life, I think it's buyer beware.
So the argument could be made that that's the real reason that a platform like Robinhood even exists. They're not really making huge profits off the retail investor. They're making profits off selling the information on the other end.
Well, Robinhood is a for-profit business, despite being called Robinhood and stealing from the rich and giving to the poor. Robinhood is a for-profit business. It's in business, and it's supported by its investors to make money. And the way they need to pay for their business is by selling the flow. It's currently legal. There are things that pop up where they are once legal and then they become illegal. For example, back in and around like 1999, 2000, you used to be able to trade mutual funds after the bell. Like, if you had good relationships with your brokers, at 4:00 every day, mutual funds are priced. And you could see what was going on in other markets, and you could trade after the bell if you had good relationships with your broker. That was one time legal. Elliot Spitzer came in and made it illegal. And he then went actually back and locked up like a bunch of the guys, or basically fined a bunch of the guys that had been doing this, even though it wasn't illegal at the time. So, the rules can change.
So they retroactively prosecuted people?
In that situation, to the best of my understanding, they did. That's not always the case. You can't always do that. But, look, it's the government. They can do what they want.
Right.
Now, again, do I think that it's rigged? No, I think that the government is trying to protect individuals. I think it's trying to protect its citizens. And if they don't, they get changed with new government that the citizens feel are going to protect them.
Remember when Andro was legal and everybody was getting swole in the gym back in like the late 90s? Then all of a sudden it was too effective. So the government stepped in and made Andro illegal. I feel like that was kind of fucked up and maybe less ethical of the government, because now I'm interested in gains, different type of gains, but illegal. The fact that they made Andrew illegal eliminated a lot of my gains. So when Robinhood gets this funding to kind of cover their shorts here, the $1 billion they got last week, what was it, Guido, like $3.7 billion?
3.4.
Tell me again, where are they getting this? They're getting this from the investors?
From their large investors. Typically, a unicorn business like Robinhood is today has very large investors, big institutional investors that have invested in them, big money managers, big insurance companies, whatever it may be. And there was effectively a margin call in their business, right? A capital call in their business. So their investors had to make the decision. We either don't support them or we support them and help them try to succeed, right?
What now? Can you tell?
The funny thing is, the number of accounts that have been opened in Robinhood because of this whole craziness has like increased exponentially. So
Right.
the underlying business seems to be doing fine.
They're going to make out on both ends.
I don't know. I'm not sure that their business model is long-term sustainable, because I think probably at some point maybe the SEC decides that it's not legal.
Also, their PR is going to come hammering down on them.
What do they say in PR? What's the old expression?
Any attention is good attention.
Exactly.
Yeah.
Bad news is good news. I mean, it's probably a good thing.
And so when you said that they had a margin call or a capital call, what does that mean exactly?
So very similar to the way that a hedge fund may get a capital call because their collateral, the amount of collateral went down versus the borrowings from the bank. The SEC requires them to keep a certain amount of reserve. And they were violating that because of the trading volumes that they experienced. And as a result, they needed to shut down and they needed to figure out how they recapitalize or, inject some additional capital or equity into their balance sheet. And as such, a bunch of their investors came in and wrote some big checks, clearly.
So anyone could come in and invest in that side of things, giving them that money.
Well, not anybody. I mean, you have to have a relationship with the firm. It's typically uncommon for individuals to have the ability to invest in like big private deals like that. Because again, you have to have scale.
So as a selfish Mets fan, how is my man Steve Cohen involved in this? And please tell me that we're not going to have another situation where like the Wilpons couldn't sign a goddamn free agent because they gave Bernie Madoff all their money. Please tell me that's not about to happen.
I think Steve Cohen is doing just fine. So to my understanding, Steve Cohen was a large investor or is a large investor in Gabe's fund. And Gabe's fund had a massive pull down in their positions, and their collateral effectively shrunk, and they had a margin call. And so the investors had to post capital. So Gabe and his, Melvin Capital turn around to their investors and say, if you don't want us to lock in these losses and you want to enable us to be able to hold on to these positions, we need you guys to invest some more capital. So as a result, Stephen Cohen, who formerly ran SAC, now runs a firm called Point 72, which is effectively his family office. I think it's like a $20 billion family office. I think it's all his money. He invested, some $1 billion along with another billionaire named Ken Griffith from Citadel, which was also an investor. The funny thing is Citadel was on both sides of the trade, because Citadel was had to write a check for Melvin, right? They probably wrote $1 billion check. I have no idea. And in addition, they're the ones who is on the other side of Robinhood buying their flow. So they were in a shitstorm, frankly, right? They had a shitstorm going on.
When you say they had a choice to lock in their losses or hold the position long, what does that mean? Like they were going to have to like just eat shit and deal with. Define that for us, because I mean you're using industry terms you don't even realize are industry. No, don't apologize. But I think a lot of people like.
So, for example, there's this thing called a margin call.
Yep.
Okay. Let's say you go to the casino, and the casino gives you a line of credit, and they say, John, welcome to the Sands, or
thank you very much.
Welcome to the Sands. We know you're such a big high roller. We're going to give you $1 million credit. But what we would like you to do is give us a couple $100,000 of deposit. And so they're holding your $200,000. They're going to give you $1 million to go out there and gamble. And you're throwing your chips all over the tables.
Balling.
Drinks flowing, strippers,
Babes
hookers,
everywhere.
everywhere.
Yeah.
It's just,
Just a regular weekend for the big guy.
It's just a complete free for all. But all of a sudden you have a bad stroke of luck and you start losing. You're losing at the craps table. You're losing at roulette. I mean, you just start to bleed.
Babes disappear.
Babes are gone. They're feeding you more drinks, but babes are gone. And all of a sudden you're down 150. Okay. $1 million, not that much, 15%. The problem is you're actually down 75% on your capital, right? Because you only had 200 grand you had to post. And so the casino gets nervous and they say, you know what? We're going to put a stop here. Either you give us some more capital and we'll let you continue to roll, or you're done, and you close out and you got to go home. Remember, when you're playing with levered money, even when you're buying a house for $1 million and you're putting down 200 or 300 grand, your first loss, right? So if you overpay for your house in a pandemic situation by 10% or 20%, you turn around to sell it, then a year later, your first loss. The bank doesn't give a shit. They actually want their money back plus the interest, right?
Right.
And it's the same thing here, right? The difference is here, so effectively that's what happens with borrowed money. But effectively here, you had a similar situation where the SEC requires certain capital adequacy levels. Right? They require these firms to have certain amounts of capital on hand to be able to buffer these types of losses. And, if you don't, is when, you risk being kind of stopped out.
So what types of things are going to be put in place to prevent another episode like this?
I don't know. Jury's still out, right? The SEC is going to figure out how to deal with this. I will tell you, it has changed the game for the money manager, for the hedge fund manager that we're shorting small cap stocks. They're going to think twice about doing that because these types of things can happen. I mean, it's 2020, 2021. You're like, anything can happen, right?
Right. I think that the big thing there is people are upset that they feel like a short is someone who's got so much money coming in that they kind of don't care what happens to a small business or like a failing industry or whatever. And you're actually betting for them to lose. And that's where the vitriol comes from. But I don't understand that, honestly, because anytime you place a bet, you're actually betting for someone to lose.
You're always betting for or against somebody.
Right.
Even as a customer, if you decide to go to the new dry cleaner around the corner, not
you're betting against the other one.
Exactly. So, I mean, the thing is with markets is shorting enables you to do it. It creates that efficiency.
Right.
Despite the fact that everyone wants, people to survive forever and get some government stimulus and invest in businesses to go on. There's a lot of businesses that probably shouldn't be in business today. Right. And, when you have economic crises, it's Darwinian, right? It's a Darwinian effect.
And so you think Robinhood is going to come out of this? You think they're going to be able to pull it off?
I can't comment on where I think they go. I mean, right now, I think they're going to do okay, right? They've gotten the capital. I don't know what happens with the long-term business model, but right now they seem to have, been okay. It sometimes like these investments become too big to fail, right? Where investors are like too far in. It's like, maybe they still see fundamental value, but got to write a check. I've been in that situation with investments before where, it was like, you're in a shitstorm. Everyone thinks you're down and out. You get up off the mat, your head's still a little spinning and, can you do this or not? And somehow you get that injection and you win, right? That can happen.
I think a lot of people, they don't really, the main concern is they don't want to see a situation kind of like 2008 where people were careless with investing in the way that they handled other people's money. And at the end of the day, the taxpayer pays twice. The taxpayer pays for the bailout and we took the hit for the entire thing collapsing on us.
So 2008, and I don't know if you can do this type of fact check, but I really think that 2008, I think the government actually ended up doing really, really well on the investments they made in 2008. So it wasn't, in fact, the taxpayer didn't pay for it. They actually made out. But I'm not saying that always happens. But again, that's what government is there to do. Right?
Explain that though, because people see the government injecting money into something to save it. And the prevailing theory is that the government has no money. It's all our money. It's all taxpayer money.
This most recent pandemic is very different than 2008, where 2008, the government stepped in and actually made investments in these companies. Like they made them as like notes, right? They made them as loans, and they got equity. And there was, it was very different than this pandemic, where you've had the government step in and help some bailouts in some companies and some industries. But this pandemic, they've actually come out and written checks to everybody, through PPP loans.
So, for instance, with the bailout with Freddie Mac and Fannie Mae, it cost them $190 billion in bailouts. However, they've netted $68 billion in profit from those investments.
Right.
So the government made money on everybody losing their homes. Those motherfuckers.
There's plenty of.
Yeah, they made money with the GM investment. I mean, so. I'm not saying that always happens, but I mean, again, like government is there to try to keep society on rails, right, and prevent complete social unrest and calamity, and
So if it's nothing like what's going on now with some of these stocks, which when I read online, people are very concerned with the government is going to bail some of these hedge funds out. That's probably unlikely.
That is, in my opinion, that is completely unlikely that the government is going to bail hedge funds out. Again, some of these stocks that right now, the last couple of days, a lot of these stocks have been halted by the SEC because of the volatility.
Right.
And I don't think that they're in cahoots with anybody. I think that there's just so much, it can be dangerous with so much retail money, again, because retail tends to be short term. It tends to be, it's
and the
dangerous.
retail money retail money is like the day trader. It's the guy who just opens an E-Trade.
Or, when my Instagram messenger is filling up with, 50 friends, in an hour asking me about that have never asked me for investment advice ever. And they're asking me about, going long or short stocks, or what I think about silver, or what I think about Bitcoin.
Well, that's the other thing. Like what's going on? Like, they're pushing this silver idea now that all the Redditors and the Wall Street, first of all, WSB should not be Wall Street Bets. It should be Wall Street Bros. And I'm going to push for that movement starting now. The idea is that if they can get the Wall Street Bets people to start investing in silver, they won't have the liquidity to also hold on to the GME and the AMC.
The challenge is, if there's no fundamental, like underlying fundamental case why you should own something, and you're just driving the price up, who gets stuck holding the bag?
I have a question first.
Who gets stuck in the musical chair without a chair? Right?
Is it true that fundamentals are the crutch of the cowardly? But no, I hear what you're saying. That's what my buddy told me too. It's a musical chairs game. Someone's going to get stuck with no seat. Yeah. The guy that buys at the top, or whatever, guy who gets in late, whatever that.
Yeah. And again, like on a short-term basis, is the same thing that we've seen going on with Bitcoin. Like, you can't invest what you can't withstand volatility and can't withstand the potential to lose. I mean, that's why they say in finance, diversification is the only free lunch.
So, I mean, I know you're not here to talk about Bitcoin, but you did just mention it. Dude, what the fuck? I have no concept of what Bitcoin is, or how we're doing it, or what's going on, or blockchain, or any of that nonsense. How can something that's imaginary have a value? And if it's got a value and that value goes up, how can I utilize the increase in value? How do I pull those profits down and apply them to my life? Like if I invest in a Bitcoin or a fraction of a Bitcoin and then it goes up, like how can I pay my bar tab with that Bitcoin?
So actually you can pay a bar tab with Bitcoin, because you can actually get a Bitcoin credit card today.
Oh, really?
Yeah.
I got to get one of those.
So
like a pimp.
Here's what I'll say. Like I thought Bitcoin was a bit voodoo for many years. And I have some friends that are like major Bitcoin guys, and have been for like, 7-8 years, have been super on the straight and made a fortune at it. And they're very close friends of mine that I thought were a little crazy. And I would say about a year ago, I became more and more interested in thinking that this is here to last. Bitcoin is basically, what do you think of gold? Right?
Well, I mean, I can go find some gold and touch it and rub it on my stomach. I can't rub a Bitcoin all over my nipples.
This is true. So I think that Bitcoin is basically the internet's personification of gold. I think it is basically the internet and gold having a child is Bitcoin. And I don't think that Bitcoin is a digital currency.
I'd like to see the consummation.
that would be an interesting one. I don't think it's so much currency. I think it's much more of an asset, kind of like gold. I don't think gold is a currency. Like we're not walking around, we're not trading in gold. You could, it used to be done, and you could trade in Bitcoin, but I think Bitcoin is literally digital gold.
And you think it's not going anywhere?
I think that the risk of it going to 0 and governments coming in, it is absolutely a risk. It's probably one of the key risks, but I think that risk has been mitigated significantly.
Gotcha.
I think I know there's been comments out of the Federal Reserve, or that should be a fact check. But there's been comments out of the U.S. kind of, Federal Reserve, the Mint, the SEC, that it's, it's kind of accepted. You've got J.P. Morgan, Citigroup, fact check on that. I'm pretty sure accepting it on their platform. Fidelity in Boston is a major Bitcoin investor. They've got a big platform for it. I think it's here to stay. And I think it is absolutely going to be extremely volatile. But I think over the next 5 years, I think you're going to make a lot of money. The issue with most retail investors is they have very short time horizons. And that would be the big difference between retail and institutional. Is typically institutional has a much longer time horizon.
And by time horizon, you mean like
the ability
duration?
to buy something and not sell it.
Gotcha. You can hold it for a longer period of time.
You were going to use an investment term. I was going to use it, but then duration.
Yeah.
Duration is an investment term. Yeah.
So getting back to like the meme stock thing that's going on right now, for people who are older than 20 years old or 25 years old who have seen Trading Places, how is this analogous to the closing scene, the penultimate scene in Trading Places, where they supply the false crop report and then they allow people to follow the Duke brothers and their investment strategy, and meanwhile Billy Ray is making a mint on the real orange crop report?
I think the major difference here is that, unfortunately, the retail investors think they're doing the right thing, but they're actually doing the wrong thing. Like I think we can all agree that GameStop.
Why are they doing the wrong thing? Like if
GameStop is not worth what it's trading at. If you're buying it at that price, you're betting on the greater fool theory. You're betting on there's another
dipshit going to come in after you
and going to pay a higher price, because the hedge funds are saying it's worth less because they've done their work on the stock.
But earlier we talked about how there's a system in place, and if there's a system in place,
what they're trying to do, in my opinion, I think a lot of these Reddit guys are trying to manipulate the stock, and they're saying, "Screw you."
Oh,
guys.
Here we go. Paul's had a couple drinks, and now he doesn't want the stock manipulated against him.
No, and it's not me. I mean, I'll take my losses on this type of stuff, but they're saying we actually think it's worth more. Okay, well, you know what? If you think it's worth more, now what's happening today, I think with all of the losses today, I think it's wiped out the returns over the last couple of weeks here.
Well, that's kind of what I was talking about earlier on, like what the difference between like what a stock price reads on your fucking E-Trade account and what the company is really worth.
Back to my earlier comment, Benjamin Graham used to say the market short term is a scale. Long term, short term, it's a voting machine. Long term, it's a scale. The weight comes out in the long term.
Right.
You see what something's really worth. Fundamental. I mean, the problem is sometimes it takes a long time to get to the fundamental price. The faster you get to the fundamental price, the intrinsic value, the faster you make money.
And because institutional investors have more of an ability to wait longer, they're going to get to the fundamental price.
They have two
retail
advantages.
Guys probably won't.
They have time, and they also have information. Like when you're an institutional investor, like you have access to great intel
from Robinhood selling your shit.
And when you're a retail investor and you're reading Reddit, like the institutional investors are doing the numbers, they're building financial models, they're talking to management, all fair disclosure.
I'm reading a meme on Instagram.
It's like an anti-vaxxer, anti-vax, can't have a vaccine.
I think that's one of the real reasons why I wanted to talk to you, is because I believe that that's exactly what goes on, and it happens in every industry. Anytime that there's some sort of an event, this isn't necessarily, I don't know, is this a black swan event? I don't know.
Buyer beware. Buyer beware.
I'm a big believer in that. But one of the things I wanted to accomplish was, I have this thing, and it's a personal thing, and I have many faults, and this is one of them. I fucking despise when people try to act like the man, like they're inside some inner circle, by dropping insider language that they learned on a meme. And when you string all these words together, sure, individually, each one is an insider term, but when you string them together, it sounds like fucking pig Latin. You have no idea what you're talking about. Happens in my industry all the time. And as this whole thing has been unfolding, I'm sure it happens in your industry. And God forbid, like someone who actually is honest in politics comes out one day and says, man, these idiots online, look at what they're talking about. Like the things that are happening online are very rarely representative of what's actually happening in that industry. And that's one of the things I wanted to kind of clear up here, because I know some motherfuckers running around the gym who are like, oh yeah, well, I'm going to short squeeze this and short squeeze that. Really? You don't even have two nickels to rub together for lunch. You're not short squeezing anything. You're probably robbing a Kind bar from the gas station. You're not short squeezing anything. So that was one of the things I really hoped to accomplish, and I feel like we kind of did.
Yeah,
and are
happy to help you on your mission.
Yeah, well, thank you for that.
Spelling idiocy.
Let me see. So I guess I kind of already asked, like, what do you think a ripple effect of this will be? It's difficult to say how it will play out, what regulations get put in place so that this doesn't happen again. I think personally, with the rash of Instagram accounts and Reddit posts and forums of people giving out this type of advice, simply putting the disclaimer on the bottom that I'm not a qualified or registered or certified financial analyst or advisor or whatever, doesn't fucking matter. Because if you got 300,000 followers, people are going to do what you say. And then it just comes back to, you know what? Who says that any of those accounts on Instagram or Reddit are not getting paid through the back door, and they're just not manipulating the market by putting out false information?
So I think that
some classic Sun Tzu shit.
Yeah. I think that it is buyer beware. And I think that the SEC is going to get involved. I think there'll be more regulation around this. I think that I also, at the same time, I also think that people need to be more financially astute. And I think that learning to invest in, trade stocks, and I think that's a good thing.
So a popular meme that's been going around is kind of exactly what you said. And it's from the point of view of the little guy. And it says, rich people are always saying, oh, learn how to invest your money. Learn how to invest your money. Oh, no, not like that. In reference to like what we had talked about earlier, Robinhood saying stop investing in, or limiting the shares and, freezing accounts. And I actually do think that they stopped on the sales too. I think I saw something like that.
I mean, look, I came from no money, and, I've made some money. And part of the learning process, like jujitsu, is getting smashed.
Right.
I mean, that's really the only way you learn. And I think that the challenge, though, is with these new investors, that they come in and they think they go from white to purple,
right,
or white to brown. And it doesn't work that way. Like, you got to get smashed along the way.
Right.
And you don't think that, I mean, these guys, these big hedge fund guys have had some major losses, and it hurts more as you get older, right? Because you got more to lose.
Right.
But you don't think they've lost before. I mean, yeah, they got smashed along the way. It's like, the guy I roll with every morning, I tell him I basically have a black belt in running my type of business.
You didn't get there without getting your scars.
Lots of them along the way. And that's part of it. And I think that, folks coming in, whether you're buying Bitcoin or whether you're buying GME, and you can double your money or triple your money, it just doesn't work that way. If it was that easy, everybody would do it. I always remember that. If it was that easy, everybody would do it.
I mean, that goes for a lot of things, I think. Yeah.
Yeah.
And as today kind of closes, I mean, it's Tuesday, February 2nd. I don't know when I'll get this thing edited and get it out there. I mean, it seems like today there's a large dip. Is this something that you see continuing to drop, or do you think that people are going to come back in? Because I know a lot of chicken shits that sold today. You know who I'm talking to. I know a lot of chicken shits that sold today who are talking about, oh, I'm going to hold, I'm going to lose everything, And then they sold today as soon as there's a dip. Do you think they're going to come back in on the dip, or do you think they're just out and they're just too risk averse?
I think people have short memories. Yeah. And I think FOMO is a powerful thing. I think the jury's out, but I think the retail investor is here to stay. I think the rise of the retail and this renaissance of retail is here. Let's see if it subsides once we have, a vaccine out there in the market and people are back to work and back in the office, and let's see if they have the time,
Do you have any questions of me?
What do you think of the whole situation?
I think it's really cool, actually. I think it's a great thought experiment. I think there's a philosophical aspect to it. I think it's great to see anytime anything like this happens, people are getting educated. And so there's a stance when this started that I'll never understand enough of this to be involved. I don't have the kind of money where I have a humongous portfolio or a financial planner or a financial advisor. But some of these retail trading apps, E-Trade, Robinhood, whatever.
You got me.
Yeah, I got you.
It.
But I think that a lot of other people, they're using this opportunity as a way to get informed. It becomes dangerous though, because a lot of people are really, really fucking dumb. And
it becomes dangerous when you bank on it. And like I started my career in like 99, and I remember the tech craze. I remember going as a young broker. I was going to this company called Art Technology Group, which was one of these high-flying tech companies. And ATG was the ticker symbol, and ARTG. And I was meeting with this young engineer, and he was like, the guy's making like 80 grand a year, and he's got $1 million of stock or something. And he looks at me and he had laid out this financial model, and he's like, I figure I can grow my portfolio at 50% a year. And I looked at him, and I knew nothing. I was like 22 years old, like this young stockbroker. And I'm like, I don't think that's possible. Like historical returns have been 10% for like 75 years or something. Fact check on that. But, that's not possible. But, what happens with individuals is they extrapolate today forward, right? You always extrapolate where you're at forward, and you think that it's sustainable at highs and bottoms, right? Tops and bottoms. And so, I think that but I totally agree with you. I think society is learning. And I also think that we're always creating history, but I think over the last year and a half, if you've been a participant and just watch what the hell was going on in the world, these are like record making. We are going to refer, just like 9/11 or the 2008 financial crisis or things that have happened.
Right. We'll remember this.
We're going to remember the pandemic. We're going to remember this craziness,
But I think that the internet, it's a catalyst. It's like pouring gasoline on a flame in terms of the Dunning-Kruger effect. Because I think the people who are totally incompetent but don't realize it, they're going to act foolishly because their confidence in what they know is going to force them to act a certain way.
It's like when actors become like philosophers on like politics and charitable and finance. And dude, you didn't go to college. Like you're an actor. Like you know how to like fake it really fucking well.
Right. And you're faking it right now.
Right. But it's like that where you have like other people all of a sudden they're like big prolific, because they got a bunch of followers, like, they can use some lingo.
But the flip side is a really smart person might get drawn in, and they might actually be able to learn something, make some money, and who knows how they'll affect things in the future.
Life's all about sizing of positions, right? And how you size your positions, how you size your exposure to something. And it's okay to try GameStop or Bitcoin or you size according to your probability of positive outcome in your mind, right?
Right. It's like when there's a really hot girl at the end of the bar and kind of like a chubbier girl closer to you.
Depends on the time of the night, how much you've had to drink, right?
Right. And what your goal is. I think this was awesome, Paul. I appreciate you coming out here. I hope that when I put this out, I don't want anyone on Reddit to think that I'm here to deem that one side of this situation is more morally superior, because I think everybody looks out their own window. And regardless
100%.
of that, I think I certainly learned a whole shitload today. And just so everyone knows, I'm fucking holding. I think what I stand to gain from my hold is not
a tax loss. Is a tax loss, so that's okay. You could use a tax loss.
Well, awesome. Thanks, and thanks for coming out, Paul and Guido. As always, thank you for producing and fact checking.
Cheers.
Well, I'm not sure if I feel smarter or stupider after that. Hopefully that clears up some of the misinformation floating around on social media. Thanks to Paul for coming in on short notice and in the middle of the week and doing this. And if you got an extra 100 mil kicking around, you're looking to invest, you can find Paul and the links in the show notes. And as always, if you dig what we're doing, hit the subscribe button, leave a kindly review, and check out our Patreon page. Until next time, more push-ups, more tequila, and don't be a coward. Hold, hold, hold.